Welcome to our discussion on crypto tax havens in Europe for 2025, a landscape that's shifting faster than ever.
I'm really excited about this, especially with how regulations are reshaping the map for investors.
Yeah, it's like these once golden tax-free spots are becoming rarer due to evolving frameworks like MyCA and the OECD's CARF
Right.
initiatives, which demand more transparency.
Yep, and that transparency, while good for the market integrity, does impact the old school crypto havens.
Absolutely. For example, Portugal and Malta have historically been magnets for crypto investors because of their lenient tax policies, but now things are a bit more nuanced.
So, what exactly has changed in Portugal?
Well, Portugal used to be the ultimate haven with tax-free crypto gains, but by 2025, short-term crypto profits get taxed at around 28%. However, if you hang on to your holdings for over a year, you can still enjoy tax-free gains.
I see, so it's shifting towards rewarding long term investments rather than quick trades.
Exactly. And on the other side, Malta, often called Blockchain Island, has maintained a friendly business environment. But don't get me wrong, individual gains aren't completely exempt because standard income tax rules tend to apply uniformly.
And what about Germany? I've heard it still offers some advantages.
Right. Germany is interesting because long-term crypto investments here can be completely tax-free for individuals if held for more than 1 year. This system essentially favors patients who aren't in it for quick flips.
But don't you think that strict holding requirement can really limit flexibility for some investors?
That's a fair point. While the 1 year rule promotes stability, it does mean investors need to be careful planning their exit timing. It's essentially a trade-off between flexibility and lower tax rates.
True. Now, beyond these established names, I've seen Andorra and Monaco popping up in conversations. What's their edge?
Andorra offers a maximum income tax rate of about 10%, which applies broadly, including on capital gains from crypto. Meanwhile, Monaco, famed for its luxurious lifestyle, has no income tax whatsoever. So, in theory, crypto gains are untaxed there. But these perks come with a catch.
Right. I imagine the high cost of living and, frankly, the exclusivity factor make them appealing mostly to the wealthy or those with significant assets.
Exactly. It's like these spots are great for high net worth individuals who can manage the upscale prices and strict residency requirements.
But with all these evolving rules, it sounds like the days of completely tax-free crypto haven bliss might be over.
Yeah, it seems that way. No government is keen to completely close off tax loopholes, but they are tightening the screws to ensure fair play. So truly tax-free isn't a robust promise anymore.
So if no country is fully tax-free now, what are investors really looking for?
They're really after low tax regimes or those with favorable exceptions. Germany, for instance, rewards long-term holding, and Portugal still offers tax benefits if you're patient. The idea is to optimize the tax burden while navigating these shifting rules.
And then there's the practical side, like the cost of living, regulatory reliability, and what sort of lifestyle you can maintain in these countries.
Exactly. It's not just about tax rates. Moving to one of these countries means assessing local regulations, living standards, and the overall cost of living. Even if you save on taxes, expensive property markets can melt away those benefits.
That's a big consideration. It's like trading one set of challenges for another, huh?
Right. Also, these programs like Portugal's Golden Visa or Malta's Citizenship by Investment come with hefty price tags in real estate investments and national fund contributions.
Yeah, and those entry barriers mean that not everyone can take advantage of the tax perks, especially if you have a smaller portfolio.
Very true. And then there's the whole process of moving countries. It's not as simple as flipping a switch. You have to consider residency requirements, the local financial ecosystem, and potential language barriers, among other challenges.
It really is a balancing act, isn't it? On one hand, you're chasing tax efficiency. On the other, you're adapting to a new lifestyle and maybe dealing with infrastructure gaps.
Exactly, and that's why, even within Europe, alternatives like Estonia and Switzerland have come into play. Estonia's digital-friendly environment and Switzerland's decentralized tax system, with its crypto valley in Zug, offer attractive low-tax pathways, although they're not completely
Right.
tax-free.
Sure. But even those come with their own complexities. For instance, Switzerland's cantonal differences in tax rates.
True, it's all about the details. Investors have to consider more than just headline tax rates. They need to dive deep into how local laws classify and tax different crypto activities.
And speaking of classifications, the general principle remains. Crypto is mostly seen as an asset or income, which means any transaction can trigger a taxable event, correct?
Exactly. Whether it's capital gains when you sell, income from mining or staking, or even crypto to crypto exchanges, you've got several tax triggers. That's why the structure of holding periods, like in Germany, becomes such a big deal.
So, given this complexity, what kind of strategy should an investor consider?
They need to look at the whole picture: their investment goals, lifestyle preferences, and risk tolerance. Looking globally might also mean considering alternatives like Dubai, where zero tax on crypto gains is a strong draw.
Yeah, Dubai really is the buzzword these days for tax optimization outside of Europe, though that move also comes with its own lifestyle changes and regulatory considerations.
Absolutely. And for those who aren't ready to relocate, setting up a crypto-friendly business in a low-tax jurisdiction or exploring decentralized finance options can be alternative paths.
But wouldn't that increase your exposure to regulatory scrutiny?
It could, and that's the trade-off. While these strategies might optimize taxes on paper, they add layers of complexity and risk, which require continuous monitoring
Yeah.
and professional advice.
I also think that cross-border tax advisory and having a contingency plan for unexpected regulatory changes are becoming non-negotiable.
Absolutely. With rules shifting faster than ever, staying updated is not just an advantage, it's a necessity. Investors must be proactive and perhaps even agile in adapting their setups as new laws come into effect.
And that's what makes the whole area of crypto taxation, especially in Europe, so dynamic and captivating. It forces you to constantly reevaluate your strategy.
Exactly. It's like you're never really done learning when it comes to crypto tax strategy. Every new regulation is a puzzle piece that might affect the whole picture.
So ultimately, the quest for low tax or tax efficient regimes in Europe in 2025 is less about finding a free lunch and more about mastering a very complex, evolving balancing act.
Precisely. And whether you're looking into Germany's long-term benefits, Portugal's nuanced system, or even the high-end allure of Monaco, the key message is this: do thorough research and align your decisions with your unique financial goals and lifestyle.
This has been such a fascinating look into the intricacies of crypto taxation in Europe. Dynamic, challenging, yet full of opportunities if navigated smartly.
Exactly. It's a constantly evolving arena, and it pays off to stay informed, consult with experts, and always be ready to adapt. Thanks for the engaging chat today.
Thank you. And here's to making smart, informed moves as the crypto landscape continues to change.